trends change constantly, so let me put that little disclaimer there. There are some financial planners, we'll call, who are either a registered rep or a registered investment advisor, whatever they are, that will put together a plan for you and say you should put X amount here, X amount there, and that's in your, you're all set. And people like to hear that because they feel, okay, I did it, I'm set, I'm done. The problem is that things change, and they change on a dime. So you can't wait until the end, necessarily wait until the end of the year to reevaluate what's going on. And that's why what I do is I'll make those adjustments as they're needed. The biggest trend is interest rates. For the past 30 years, interest rates have been declining. We went through the 70s, the early 80s, where interest rates were very, very high. You're looking at 16, 17% interest rates. Since then, interest rates have declined. Every time the market had a problem, 1987, the dot-com crash, all these things, the 9/11, whatever, the Federal Reserve lowered interest rates. This has been going on for years. By lowering interest rates, you're allowing people to borrow more money. Businesses can borrow more money at a lower rate, and they can expand. So if you're, in a simple term, if you're a consumer, a regular person, and you own a home, and your interest rate, and I've gone through this, if your interest rates were 8 or 9 or 10%, and the rate dropped to 7%, it's like, wow, I can save X amount of dollars per month, and what happened because of that, the price of the house goes up, because there's more consumers that are able to buy more homes. And because the price of the house goes up, now you can withdraw some equity that's in the house, and you can take that equity and go out and spend it. So by doing that, you're fueling the economy. So for the past 30 years, interest rates have gone down, and they continued to do that until whatever it was, 2008, 2009, we ended up at zero. We're in a period of time where we have this headwind of interest rates going up, and that's going to continue to be a problem. The Federal Reserve is raising interest rates right now, today, because they want to have the ability, if there's a crisis, to lower interest rates. When interest rates were at zero, they have very limited firepower as to how they could save the economy. However, if interest rates are high, they can always lower them. So they're trying to get the interest rate up to a certain point where they have at least enough control that if there is a crisis of some kind, a banking crisis or whatever it happens to be, that they have the ability to lower interest rates. So that's really the number one issue with the trends in the market today. The tariffs and everything else play into that. If we don't know what if the tariffs are inflationary, that puts some pressure on interest rates. So again, you're looking at that increase in interest rates. That's going to be an issue for investors going forward.